Okay, so you're an entrepreneur, maybe a project manager, or you're part of a corporate team planning a longer stay out in Asia Pacific.
Right?
Finding the right place, maybe a great service department or some other long-term accommodation, that often feels like the easy part.
It can be, yeah. There are good options out there.
But the real challenge, the thing that really shapes your budget and your whole strategy, it's figuring out the tax situation once you're actually there. And wow, is it changing fast?
It really is a dynamic environment. We've looked at the sources, and they show jurisdictions across Asia are, well, fundamentally rethinking how they handle cross-border income and residency.
And these aren't just small tweaks, are they?
No, not at all. These are significant policy shifts. Governments want to boost revenue, which creates, complex new hurdles for compliance.
But also some opportunities.
Surprisingly, yes. Very specific, targeted opportunities alongside the challenges.
Right. So our mission today is to cut through that complexity. We're boiling down these sources to the essentials, the financial and residency details you absolutely need to know right now. We'll focus hard on Thailand's big new kind of dual strategy.
Yeah, that's a key one.
And then we'll broaden out, compare some of the region's most tax-friendly spots.
And the bigger picture here, the sort of backdrop to all this, is that global trend.
Yeah.
Governments everywhere are tightening up fiscal policies.
More scrutiny on money moving across borders.
Exactly. So for professionals planning those extended stays, you just have to adapt. Understanding where you count as a tax resident, not just a visitor, that's ground zero.
Okay, let's unpack that foundation then. For someone settling in maybe into a serviced office or a long-term rental for months, what's the number one thing that decides their tax fate?
It really boils down to how long you stay, your residency duration.
Okay.
And what's striking is how consistent a certain threshold is, especially in Southeast Asia. Take Thailand, for example. The magic number is 180 days.
180 days.
Spend 180 days or more there in a single calendar year, and boom, your tax status flips. It doesn't matter what kind of temporary visa you're on.
So wait, if a company sends a team over, maybe using one of those flexible extended stay places, and they schedule it for, say, 185 days.
Yep.
They've just crossed that line. They're not just business travelers anymore.
Exactly. They are now tax residents in Thailand, subject to Thai rules on their income, potentially even worldwide income, depending on the specifics.
Wow, that must make planning complex. Corporate teams must be thinking really hard about rotation schedules then.
Oh, absolutely. That 180-day rule isn't just some guideline. It's a hard financial boundary.
The line in the sand.
Precisely. It forces you to rethink long-term project deployment. Maybe two separate 170-day stints are better financially than one continuous 8-month assignment.
Okay, this brings us neatly to Thailand's interesting dual strategy you mentioned. Because on one hand, they seem to be rolling out the red carpet for certain people.
That's the opportunity side of the coin, yes. Thailand is making a big play to attract skilled Thai nationals currently working overseas, trying to reverse the brain drain.
How are they doing that?
With a really attractive tax break. A flat 17% income tax rate for these returning professionals.
17%. That's quite low compared to their usual rates.
A substantial saving, yes. Designed to be very tempting.
Are there strings attached? Specific requirements?
Oh, yes. It's very targeted. You need a bachelor's degree, minimum. And at least 2 years of work experience outside Thailand.
Okay.
And it's also tied to specific industries. The employers benefit, too. If they're in sectors like tech, advanced manufacturing, basically high innovation fields, they get a 50% tax exemption on the salary costs for hiring these skilled returnees.
So it's a double incentive.
Right. And the program runs until the end of 2029. It's clearly a strategic push to build up their innovation capacity.
Okay, so that's the carrot. Now let's talk about the stick, or at least the major policy shift that's affecting existing long-term expats, retirees, remote workers, basically anyone living there long-term and relying on foreign income.
This is the big one, the operational change that kicked in from January 2024. It fundamentally alters how foreign-sourced income is treated when it's brought into Thailand.
Right. The old system had that timing loophole, didn't it?
It did, a huge one. Previously, overseas income was only taxed if you transferred it to Thailand in the same calendar year you earned it.
Which meant if you earned it in, say, 2022, but waited until January 2023 to bring it in.
It wasn't subject to Thai tax. That timing was everything.
But that's gone now.
Completely gone.
Where?
The new rule states that if you are a tax resident, meaning you've hit that 180-day mark, any accessible foreign-sourced income you bring into Thailand is taxable, period, regardless of when you originally earned it.
Whoa, hang on. regardless of when. So if I earned a bonus 10 years ago, catch it offshore, maybe invested it, and now I remit some of that into Thailand to pay rent on my long-term place. Yes.
That old money gets taxed now as income in the year I bring it in.
That is the crux of the challenge this new interpretation creates. It removes that critical timing element expats relied on, remit that old income now, and it becomes taxable income now.
That feels almost punitive. It really changes the game for long-term planning.
It's a massive shift. It forces a complete rethink for potentially thousands of people who've structured their finances around the old rule. The impact is hard to overstate.
Was there any mention in the sources of, like, a safety net, any exemptions or grandfathering for people already established there? That's crucial.
There is one absolutely critical exemption. It acts as a dividing line.
Okay.
Savings that you accumulated in your foreign accounts before December 31st, 2023 remain exempt.
Ah, okay. Before the end of 2023.
Correct. But, and this is key, you need meticulous records, proof of when those funds were actually earned or accrued.
Got it. Documentation is everything. Absolutely. But for any income earned after that date, January 1st, 2024 onwards, if you bring it in, it's potentially taxable in that year. The old timing strategy is defunct for new earnings.
This complexity in Thailand really highlights a broader concept we need to understand across Asia, which is the idea of territorial tax systems.
Yes, that's fundamental to the region. A territorial system, basically, means a country primarily taxes economic activity happening within its own borders.
So money earned genuinely outside the country.
It is generally not taxed by that country. That's the principle.
And the sources mentioned a few key places that operate like this.
Right. Thailand technically still is one. Then you have Hong Kong, Singapore, and the Philippines, often cited as examples.
And this is but the new Thai rules just perfectly illustrate, just because a country calls itself territorial doesn't mean your foreign money is safe from tax there.
Exactly. That's the critical nuance. The real impact depends entirely on the country's specific rules about remittance, about bringing the money in.
So Thailand is still territorial. They don't tax your UK salary if you keep it in the UK.
Correct. But the moment you, as a Thai tax resident, remit that UK salary into a Thai bank account.
Bam! It triggers Thai tax liability under the new rules.
Precisely. So when you're planning that extended stay, don't just look at whether it's a territorial system. You have to dig into the precise remittance laws. The devil's in the movement of the money.
Okay, so if Thailand's new rules mean people need to rethink things, maybe recalibrate their plans, what are the alternatives? The sources flag some other spots often seen as tax-friendly for professionals on longer assignments. Let's do a quick comparison.
Sure. Singapore comes up a lot, obviously a major hub.
Yeah.
Its big draw is the lack of capital gains tax.
Right. So if you're an investor or maybe in venture capital, where your gains come from assets growing in value.
Singapore looks very attractive. That's a foundational benefit there.
And Hong Kong, similar but different.
Similar in some ways, but it goes further according to the sources. Hong Kong is noted for having no capital gains tax, plus no estate tax, and no tax on dividends.
Okay, that's a powerful combo, especially for wealth management or significant investment portfolios.
Definitely. Those additional layers make it exceptionally appealing for certain financial profiles.
What about Malaysia or the UAE? They were mentioned too.
Malaysia offers a clear advantage. No capital gains tax on your overseas investments.
Okay.
And the UAE, while technically outside Asia-Pacific, is a massive regional player. It's often highlighted as, a major tax haven. No capital gains tax, no estate tax, and crucially, no personal income tax at all.
That's the big one. No personal income tax. But there was a catch noted for the UAE, right? Something about corporations.
Yes, that's important context. They recently introduced a 9% corporate tax. So while it's still very attractive on the personal side, businesses operating there now need to factor in that corporate tax rate. It complicates the structure a bit for companies.
And the sources also gave a quick nod to Brunei and mentioned South Korea using tax incentives for specific sectors.
Right. Brunei was mentioned. And South Korea is apparently using targeted tax breaks to lure startups and investors in advanced fields. It just shows how everyone's using their tax code strategically now.
So pulling this all together, what's the bottom line for you, the listener? The main takeaway seems to be that these differences are huge.
They really are.
Whether it's Thailand's strict new remittance rules or Hong Kong's lack of capital gains tax, these details have to drive your decisions about where you base yourself or your team for the long haul.
Absolutely. The sources make it crystal clear. You can't rely on old assumptions anymore. It's just too risky financially.
So what actions should people be taking?
Expats, Corporate teams, anyone staying long-term, they need to adapt. That means keeping incredibly detailed financial records. Understanding that December 31st, 2023 cutoff date in Thailand is vital.
And getting advice.
Yes, crucially, getting local, specialized professional advice from accountants or lawyers in that specific country.
That proactive step, checking every decision, whether it's signing a lease on a service department for 6+ months, or how you structure bringing money in, getting that vetted by local experts.
It's not really optional anymore, is it?
Seems like it's mandatory now just to navigate this tighter global environment safely.
Which leads to a final thought, maybe something for you to chew on.
Okay.
Given this global push for more fiscal scrutiny and this clear financial risk tied to crossing that 180-day residency line, how might companies and entrepreneurs start structuring these long-term Asian stays differently?
You mean to deliberately stay under that threshold?
Exactly. Could we see a big shift towards, say, highly structured back-to-back 170-day deployments?
Right.
Using service offices, shorter-term accommodation, all designed specifically to optimize the finances and avoid triggering full tax residency under these new, stricter rules.